Here is what happened today on another incredible ride and volatile session. That big 0.5% rate cut by the Fed this morning doing very little to calm markets, maybe exaggerating the selling. The Dow giving up more than half of Monday's gains. At the end of the day, down 785. Keep this in mind. The Dow is now down 3,500 points from its highs of less than 1 month ago. Stocks, of course, a story. But the big story of the day was the bond market. Holy smokes. Bond yields continuing to fall on the 10-year. In fact, that free fall right at 2 p.m. Eastern time, we were at 0.99%. My drawing is not good, but you get the point. Under 1% on that benchmark 10-year note. We have never seen that before. Buyers not just coming into bonds, they also flocked into gold and the gold mining stocks. The precious metal up 3%, the gold miners even more. The GDX, one of the big gold mining indexes, up 5% today. Now, if you remember, if you tuned in last night, we hope you did, everybody around the desk said that they were not buying into the gains. In fact, Guy Adami, I believe you said we would rally to 3125 on the S&P 500, then probably fail. You nailed it, my friend. What do you think of the markets now? And more importantly, what do you think of what the Fed did?
No, I appreciate that. That was just sort of a math problem, and we sort of put it out there in terms of where it could have traded up to and fell. And again, around the deck, we were collectively skeptical. And I'll say this, and Nathan's been on this. Yields have been going lower long before coronavirus was the thing. Gold has been going higher long before coronavirus was the thing. This just sped up the move. We also said that at a certain point in the yield curve, at a certain point in 10-year yields, you're going to hit a point of diminishing marginal returns in terms of what it means for the broader market. And I thought that was around 1.4% in the 10-year. And that's proved to be somewhat correct. In terms of the Fed, we only have an hour, and I can rail against them for at least 5. But they are totally missed the boat. They've become completely beholden to the market, and now the market is completely in charge. It's sort of a scary thing. 1% in 10-year yields in the United States is not a healthy environment.
Do you think in any way, Tim, that what the Fed did exacerbating the selling? I mean, go home tonight and say, don't worry, honey, I stocked up on ammunition and fire extinguisher. I mean, and you're going to, what happened? Did they spook us?
Well, it certainly didn't build confidence. And in fact, the communique we had from the G7 and from central banks earlier in the day was kind of nondescript and amorphic, as you might expect. But at least it showed some coordination and at least showed some ready to act. When you cut at 50 with no fiscal behind it, with no plan, and just some senses that we're actually trying to play the psychological game with the market that knows and expects and needs psychology from the Fed, it totally backfired. And again, to get any follow through right now that's going to make a difference for the market, you need fiscal packages. What China came out with a couple of days ago, 1.2% of GDP, begins to make sense, even though that's just the beginning here. So when you think about the market today, and we've talked about the bond market for as much as equities have done, the 30-day move in the 10-year from around just right at 180 down to where we are today is historic by any measure. And you either have to say equities are way too expensive with bonds here, and leaving aside how we value stocks, or what's happened in the bond market is actually offsides and pretty, perversely low.
Well, it's offsides. I mean, the Fed kind of lost last summer when they decided that they were going to start cutting rates for the first time in 10 years, when they did with the stock market at all-time highs, with the Trump administration on a daily basis talking about how solid of a footing our economy was on. So whatever they were calling it a mid-cycle adjustment, that's where they lost their credibility. Now, I know Guy thinks that they lost it a long time ago, but there was no reason for that. And that fueled that kind of late-year stock rally that we had, coupled with whatever you want to call it, the repo
QE4.
operations or QE4.
Yeah, we'll call QE4. It's what it was.
So I guess what I find really interesting is here, I'm not particularly panicked about this coronavirus. I mean, when you think about what's going on here, I mean, the market was going to correct one way or another. It's just giving it a bit of an excuse, but the market should have never been close to 3,400 in the S&P 500. So where are we right now? Where do we close today? Right at 3,000. That's where the S&P 500 broke out in late October, when the Fed started kind of expanding their balance sheet, and after they had the benefit of 3 consecutive 25 basis point rate cuts. And I'll just make one other point. Whatever you want to call it, emergency, preemptive, these rate cuts, my history watching this and watching stock markets, you go back to 2001 when they had surprise rate cuts. Well, you know what? The stock market got cut in half in 2001 to its lows in 2002. And then you go back to 2007, 2008, when they started doing surprise emergency rate cuts in between meetings. And again, the S&P 500 got cut in half. So the market does not really love these sorts of things. And I think that, it was pretty well telegraphed.
Yeah, and also, with all due respect to everybody, I'm not trying to insult anybody on this screen or any others that kept calling it a surprise rate cut. That's malarkey, Kevin. Karen, I'm sorry about this. Kevin Flynn's our producer, which is, we've talked about 100 times today, by the way. Kevin, I love you, brother, which is this, is that the CME futures showed a 100% chance of an intermeeting rate cut Sunday night. I tweeted it out. I mean, yesterday sort of the Fed gas on the fire, Karen, and that's all we're going to get?
I don't know if that's all we're going to get. I mean, I think on Friday they tell.
By the way, you should have hit him with you should have hit him with a Bobby. Yeah, well, Bobby.
Or
sorry.
But listen, I feel badly for Jerome Powell, right? Everybody's sort of telling him he's doing a bad job. Let me just sort of add to I don't agree with what he did. I think that
why not?
Because you can't cure the flu with a rate cut. Right? That's what we have. When in 1998, when the Russian debt crisis happened and long-term capital was blowing up, that was completely a financial crisis. And that rate cut actually did solve that crisis. This is a very different kind of crisis. This is the consumer very nervous, right? Not only about their health, but also about their businesses. And the 50 basis rate cut, I don't even know why you need to do it now. Why not wait? Let's see.
It's not preemptive. And just to be clear, because we've talked about the Fed in the last 6 months. Where were they going to get ahead of the market? Were they going to get ahead of the curve? Were they going to go 50 instead of 25? And we were talking about that back in late September and October. This is reactive. This is chasing your tail, and this is a Fed that at this point, seriously, I mean, Bank of Australia went 25 bips last night, left them with 25 bips. I know that there's more tools in the toolbox, but ultimately, zero interest rates are here, and this is not solving anything.
Yeah, but I kind of disagree with you guys. I mean, so like I just said, I thought last summer's rate cuts were a real problem. I think people really should have been upset about that. I think what's going on now, if you think about our economy and 70% of it is the consumer, and you think about the potential for economic shocks, I mean, this is the sort of stuff that they should be getting in front of, in my opinion, because when you think,
but because they did those other
they're not in front of anything.
Here's the thing: when I go back to and I think about like the olden times, like the two times that we just described in 01 to 02 and 07 to 08. I mean, those were really kind of existential threats. When you think about in 01, when they started really leaning on rates going to zero, nobody knew what this war on terror was going to look like, and nobody knew what the financial crisis was going to look like. But we knew the worst case scenarios were really bad. No one knows how this thing's going to play out. I don't think it's going to be particularly that bad, but the reaction to it is crazy, and that is the thing when you think about how much debt is all over the planet.
So let's back it up. I want to go back to what my good friend Kevin over here said just a moment ago, which is, no worries. Is this a crisis? You said crisis. Is it?
Is it a crisis? Is it a crisis? I don't know what the definition necessarily means. I think it is of deep concern that the way we go about our daily business in the United States is changing, right? We all know of a conference that was canceled or a trip that they're not going to take or just pulling back or buying extra supplies. Those two things.
But to Tim's point, the monetary and fiscal are very different, right? So let's say I'm supposed to travel this weekend, true story. Let's say I just change my mind. My dog is going into a kennel. That's true. If we don't travel, the dog doesn't go into the kennel. That kennel owner, a small business owner, does not get that revenue. A lower rate is not going to help that kennel owner or the thousands or hundreds of thousands of small businesses around this country.
Look, I think where we've gotten to is we're facing, and help me, Dan, if this is what you're talking about, what we were facing in the fall when the Fed gave us QE4 was essentially growth and recession risk. And markets were not only not pricing that, but the S&P went on a 19% run, which led you to the dislocation that we've had over the last 6 trading sessions. That's what set this up. Now, there's no question that even before that, even before we signed phase 1 of whatever trade deal we did, the market was concerned about global growth. The market was concerned about the fragility of an economic recovery that frankly, we don't know where it is. So this is about recession risk. This is about ultimately pricing where equities should be. And to me, then you get into the technicals. Then you get into markets don't trade up or down 5% when markets are healthy on any given day and then have the reaction they did and have a Fed chase a 50 basis point cut. So without being alarmist about it, if you look at the stocks and you look at the S&P and you look at the technicals, and these are just guideposts. I'm not a technical guy, but I can tell you that 28.55, which is where we challenged yesterday, which was the beginning of this run back in October 3rd that took you to those highs, we have to get back there. And if you look, we basically closed near the lows.
Yeah, and that's a great level, Tim. I'm glad you bring it up because it's that level you just is the 50% retracement of the December 2019 low, which we all remember, 2350 or thereabouts, and the recent high. It makes a lot of sense, and I agree. But in my opinion, again, the bigger picture is none of these central bankers have the temerity to allow a downturn to happen. You know what? Guess what, folks? And this
temerity
is
an interesting choice of words. Some might use another one.
If this was, a different show, I could use a different word. Trust me, I would. But downturns are a natural part of the cycle. You need them to happen. You have to allow it to happen. By not allowing it to happen.
Is there anything natural about 1,000-point moves up or down 4 out of the last 5 days or whatever it's been?
When it's going up 200 points a day for weeks on end with nothing structurally behind it, we don't talk about that. We say the fundamentals are so strong.
This we have talked about.
I know we have. I'm
ETFs,
saying in general.
Trading.
You know what I'm saying. It's just as ridiculous on the way up as it is on the way down. And we talk about all the time. Markets go down faster. Allow the downturns to happen, and I don't think you'd have moves to this magnitude. But nobody's got the, I'll use the word, stones to allow it to happen.
Why, Dan? Why didn't the market tried to react when the Fed came out this morning? And then it just failed miserably at one point down 1,000.
It's just the lack of visibility right now. I mean, so I would just tell you that I don't really believe this is a health crisis right now. When you think about the amount of cases and the way it's spread and how many deaths there are, it's not a health crisis. It is a financial crisis. That's what's going on. When you see headlines that, millions, there was a headline on February 22nd on Bloomberg that millions of financial firms in China could go under, could go bankrupt if the banks don't act. That was 2 weeks ago. And now I heard on the network all day today about small businesses to the point that you just made here in the U.S. What sort of bailout are they going to need? We just heard about from the administration that they might pay hospitals and insurance companies and all this.
But that's a fiscal stimulus.
Well, I understand that, but my point is this: is that we're talking about monetary, we're talking about everything now. So you're not throwing that at a human you know what I mean? This is not a humane thing. This is a financial crisis. There's been too much debt all over the planet. We know that there's been a rolling financial crisis from here in the U.S. in 08 and 09. Obviously to Europe and the sovereign debt crisis, and everyone's waiting for it to blow in China. And this virus couldn't have started at a worse place on the planet than there, and maybe it's.
Well, it's a good point.